The S&P's been on a roller coaster over the last month or so, and FinTwit is divided, Mike. Bottom or bust. Will the codes and the signals take a look at VIX support levels and Fed policy clues? So this last week has been pretty interesting, right? We're heading into OpEx. Actually, today's OpEx. The question is vol well supplied? Are the Vanna and Charm flows done? And what does next week look like? So just a quick refresher to some people who might not know, we're dealing with OpEx is option expiry. Options expire all the time within the calendar year, but at certain periods of the year they coincide. The daily and the weekly and the quarterly coincide in at the same date, and that's today, Friday 21st. And there's 4 times per year that happens, and when that happens and that expires, that means people are in a sense unhedged in the short term.
Mhm.
So that if there was going to be any catalyst whatsoever or any downside pressure, then the market could drop out, which is why most market crashes that you see happen in February, March, or September, October. So what's been interesting is if you've been following Spot Gamma over the last period or so, I really don't know between Spot Gamma, Tier 1 Alpha, and Kim Carson, you get a nice breadth of options information. And what's been interesting here is that people have been talking a lot about online about this idea that there's $4.5 trillion worth of notional option volume that is clearing today. But Spot Gamma, they talk about this idea that if you delta adjust that, it's only about $1.5 trillion worth of option notional value, option value that needs to be decay today. That means we're about 50-50. Like calls and puts are about 50-50 in the market. If we were screwed dramatically in one way or another, then there would be this case for the market to drop or to rip. But since we don't have that, what we're getting now in this bounce is as these options expires, the market makers can sell their hedges. So they've been buying in order to support the puts that were there. They can sell off, and so you get this range that the price stays in, which is what we've been seeing. And so I just want to say one last thing. There's the JP Morgan. Is it a straddle that they have? I forget what large put position that they have on, or some sort of complex option structure that makes it so that these options levels, these major option levels, basically are magnets for the price, and it pulls the price between these levels. That's a quick pitch of what's going on right now.
That's fascinating. And as usual, it's always interesting to see how this lines up with technicals that I try to keep an eye on. Just to pull up one chart that I know we've brought up several times on this show. The first thing I'm always looking at is overall what the Shiller PE looks like. And I think I've mentioned this a few times here. Anytime in the past that we have seen really elevated valuations for the S&P 500, there's usually been a pretty big pullback that follows it. We saw the .com bust where valuations were in the 40s from a price to earnings perspective. We saw the 2018 pullback. We saw 2021, and now we're right up in this range again. What I find interesting is we were right up at 37, 38 in terms of average PE, and now this is the start of what I would feel is like a larger potential pullback in overall valuations, getting closer to a healthy range. There's still more room to go here to get us closer to where I would say is a more modern valuation range. I would hope to see most of the S&P 500 companies somewhere in the 20 to 25. I don't think we get into the 15s where that feels like a traditional metric or rubric for investors in the past, because there's so much growth involved in US tech companies now, and they make up most of the index. But still, 35 is a fairly overvalued market. There's a couple of issues with, I think, the state of the market at the moment too, which is one of the key variables we're going to need to be looking for in terms of a bottom or a rally in return is what earnings revisions start to look like going forward. And we've got a couple quarters to really listen to the major S&P components and where their earning revisions show up. And we're going to need some growth-related policies to come out, tax cuts, deregulation, things like that. But one of the other things that I'm really concerned about is the fact that the Fed decided to remain paused. And obviously, higher interest rates are a cost burden to most businesses, especially as they restructure their debt. That's going to continue most likely to be paused even into May. Right now, there's about an 86% chance of a pause on the May 7th meeting. And then I'm just now seeing this curve start to shift a little bit, but in the 18th of June, the futures market is predicting about a 67% chance of finally seeing a cut. So we've got a little bit of time before we start to see 25 basis point cuts. It's going to take a little more time to see some of that cost come down even further. We're at least 3 or 4 quarters out from earnings revision starting to look much, much healthier. So while from a technical perspective, just looking at the S&P 500, let me share my window here. We did pull back enough to say that we're almost at that 0618 line on the Fibonacci. If we're looking at 510.27 being the bottom and the peak being somewhere around here about 613. We touched almost that 0618 line. Looks really good from a technical perspective, but this line here, the 200-day moving average, is the one I'm concerned about. We're starting to see the formation of what I would consider a pullback, and obviously next week's trading week will be the confirmation of that, but we could barely even get back over the 200-day moving average. I'm really not expecting that we see a continued rally from here. I would need to see a lot more evidence from an earnings perspective and a valuation perspective, and we're just not in that territory. In which case, I actually think that we could see a larger pullback down to the 520 range or even potentially 540.
Right. So I had that level there too. I have the 52.73 as the target for what I'm aiming for, all the way down to around 52.35. So that lines up close to what you're talking about there.
Yep.
I just wanted to bring up here just a couple of points because one, I'm going to play just a quick interview with Kim Carson and Mike. I forget what his other name is, his last name is, but they talked about this. This is from the 14th, talking about what this week might look like, and then what to look out for like next week coming up right now. So I thought it was interesting. Let me just pull it up real quick. If you guys are not following Jam Croissant on Twitter, you're doing yourself a disservice. All right.
Also, please do us a favor and pronounce it with a French accent as well. Thank you for that, Tom.
It just comes naturally.
Of course it does.
That so many parts of the bond market, even high yield, junk bond.
You know, there's a lot of inflation out there. So today we have guest inflation. Instead of one guest, I have 2 guests. Let's get right into it. We have Mike. We have Chum. What do you think about volatility here? Is it giving us any clues? Not volatility like choppy, like implied market option volatility.
Well, we had a pretty good, the administration came out and really told you what they were going to do. They're trying to take down the economy, take down the market. They weren't going to stand in the way. So
we're going to look at that in a second. The administration has told us that what they want to do is take down the market, and they have been saying that.
As well, documented, and so the volatility just hasn't been there. It's been a slow burn move down. The problem with slow burn down is if you have a hedge, it's not helping you here. And sometimes that could be the pain trade, not big vol explosion that everybody thinks. And for a lot of these hedge funds.
So that bounce you were showing on the SPY, you're like, it hasn't reclaimed. But because it hasn't reclaimed, calls are not going in the money and puts are not going in the money. They're bleeding out theta. And then with options expiry, which expires now, there's a bunch of people that go, damn, if we were just down another 3%, I would have made my year. And other people, well, we're just up 3%, I would have made my year. And the market is always trying to do the thing that hurts you the most. And so this sort of like weakish sort of bounce here, this dead cat bounce over here, is to be expected. And this is called on the 14th.
Funds that are having the multi-strat, that are having problems, that's probably the worst case scenario as well, because as the vol gets compressed, things start moving away from each other. You get dispersion and a correlation breakdown. So I think that's a little bit of what's going on. It's actually a pain trade as vol comes lower.
What do you think?
I think the correlation story is a big part of the story. We've seen about a 10% sell-off in the market since mid-February. Now, what we'd seen prior to that, it was just saw a market where, S&P 500 would be not moved that much, but you'd see big moves up in Amazon, big moves down in Tesla. That compressed kind of index volatility. When volatility gets correlated, things start moving fast, and that's sort of what we saw over the last month. Now, today, we're rallying. We're seeing volatility come in. We're going into a weekend. Things are quieting down for today, but I think we've got some catalysts in the future that we got to look at.
Just because the big boys are doing something, does that mean they're going to be right?
Oh, absolutely not. And actually, what's happening right now is the big boys are having to delever. They're being forced into these trades. So this is a deleveraging event. like Mike said, I'd be a little careful here. I mean, I think you can get a little rally into the weekend. These are Vanna Charm flows that we talk so much about. These buyback of deltas as vol decays. We're heading into a big quarterly March OpEx. That matters. The skew decays, and that sends deltas back into the market. But those are structural flows, and when those go away, you may not have anything behind it.
You know,
So that's the most important part there, that these structural flows, that it's market makers that are not trying to make any directional bet on the market at all. They just have these puts that or options that are sold on one side, and they have to balance their books by hedging their position, and they hedge their position by buying or selling the futures depending on what asset is being what options they sold. And so as these get the options expiry and those disappear, well, they don't need those hedges. In fact, if they keep those hedges on, now they're no longer delta neutral. So they have to then they buy it back for, we saw it during the week, it buys back, and then at the end they go, okay, well, if this is all the buying pressure that we've had this week, and it's not being supported with other people buying in at the same time, well, what's the story going to be like next week when the flows are gone? These Vanna and Charm flows are done, like they're done. So we'll see what happens. I mean, Sunday night, I'm going to be looking at the futures market to see how this is open. And before that, I'm going to be paying attention to Bitcoin to see what that's doing, because that'll front run it. And we've seen this sort of like eke out in Bitcoin too, where it's basically been behaving in the same way. And so we'll see Saturday how tonight and Saturday how Bitcoin, actually, no, forget it. Saturday, Bitcoin doesn't do anything. Sunday morning and Sunday during the day, we'll see that. And then we'll see what futures open up later on. Oh, you're muted?
It's going to be an interesting trading week next week then, for sure.
That's right. Also, so I was wondering, okay, what's the catalyst? Like, I don't know what the catalyst is. I'm not sitting, there's no obvious catalyst to me. And Brent, shoot, I forget, Spock Adam, remember his last name? Brent K is all I know him as. He makes the case that tariffs, the April 2nd deadline that Trump has provided for tariffs, might be one of the things that's causing some volatility within the options market. So I just wanted to play real quickly just a couple of points that he's made. One, because I think it's super important. We can only give you like a general overview of like options information. Like neither Mike or I are experts within the option space, but it is super useful to, if you have a head for it, to use it as a confluence for your own indicators for what you're watching, so that you could contextualize the market movements that you're seeing. So we already saw Ken talk about the positioning. Here we actually see the spot gamma tool and how they're seeing the structure of the market here. So let me just play this real quickly, where he's going to talk about the VIX term structure that we're seeing right now. And this is from Fed Day, so that was Wednesday. So this chart that you're seeing is the volatility surface for VIX. So where he's pointing at is really high because volatility is high, and then later on it ebbs away. But there's these kinks that are happening within the structure later on that he's going to talk about.
So far, we're still pricing in probably about 1% of move, because the Fed's about to start talking about here 45 minutes. And then if you look out in time, the term structure is actually pretty flat. And what I think is kind of unique is you get this little bump here, which is right around the anticipated tariff date. And so what this tells me is that we could get a release of vol around the FOMC, but then we're still going to have some stickiness because of this tariff overhang. And this tariff overhang really seems to be, a critical development here.
So that tariff overhang is causing a little bit of more uncertainty, and all you really need in this window of weakness here until options start picking back up is any catalyst that starts the downside move while people are no longer protected, and they're no longer protected right now. They have to put on those positions next week. And so if we jump just quickly to actually, no, we don't have to go through all that. Basically, he makes the claim that support and resistance levels are have been maintained this week because of these major options positions that have been on. So here around the 5750 level, and then lower down here because of JP Morgan strike at 5500. And so we've had this bounce basically in this range as the price is being squeezed between here. And if we had a big catalyst that would have pushed us into one or the other here, we would have rallied up, or we would have crashed down, but that didn't happen yet. And so he goes on to actually say this last thing, that
but that is the extreme sentiment.
If we take a look at the what is it? The IV rank for a bunch of assets within the space or stocks within the space. He's seeing here when he's taking a look at crypto that MSTR, Mara, which is a miner, some crypto stuff is actually there's not a lot of negative sentiment within the option space, which might say that we might get a short-term bounce. And I've actually been waiting for expecting a short-term bounce in Bitcoin to the VWAP level at around 88. So 87.7, 88. I've been expecting a bounce there with a short then down to 74. That's what I've been anticipating.
That feels right.
And so I like that the option space is sort of like confirming that we had this weak demand, maybe a little bit of a bounce, and then, well, if there's no supportive flows that come in, look out below. We should get another leg down. And then if Trump decides, hey, let's go big or go home or whatever on April 2nd or anywhere near there, who knows if that ends up being a catalyst lower. Now, if we get past that, if we get past, April 2nd, April 5th, 7th, and we haven't had any big thing down, then I go from your liquidity indicator, Mike, that I use an offset for that for 78 days. And that suggests that we then take off and we get a nice rally up, basically all-time highs for Bitcoin and S&P and NASDAQ. And then we roll over as we head over to June. And it turns out, no, actually, things are not as good as everyone would hope they would be, and then we roll over into the recession second half of the year. That's my base case.
Okay, so you're still sensing that there's some potential for a recession there.
It depends on the liquidity. So because actually, let me just pull it up because frankly, your liquidity tracker has been like invaluable to me, especially with the offset on it, where sometimes to the day it calls bounces. Let me just pull it up here real quick. I use a 78-day offset, which would suggest that here around April 1st, April 2nd or so is the bottom for basically liquidity, and then a ramp up, and that liquidity, we even made a new all-time high for liquidity. So I'd expect that we get back to all-time highs for Bitcoin at least, and usually with this sort of momentum, with propelled by calls and leverage, you can get even higher than that. So even though this is as high as it was over here, we're starting from a higher low versus over here. And so I totally think we can get 150, 200,000, even 240,000 on Bitcoin. But when I see this roll over, then I'll know, okay, that's where I'm going to start looking for a peak in liquidity. The issue is that if the Fed then starts, you said the Fed was we're moving towards potentially a cut from the Fed in June. So what does that do? The cut in Fed for June, usually when the Fed cuts, for the cut, it makes everyone panic. The market falls, and then it only really starts picking up like after that point. So I would expect a drop in June, July, August, pretty significant drop into the next summer is a low period of volume for the market. And then the next quarter, the options expiry is September, right? So that could all play together to have this massive drop that starts, June, July, and continues all the way to the end of the year. And that would cause a recession within markets.
I could see it. I mean, especially as the second and third rate cuts unfold in July and September, and by October, if there's continued rate cuts, I think that could be the early signal. But I think that's kind of the whole point here. Is it's hard to tell where markets unfold here and how much further they pull back over the next 3 to 6 months. But I think my confidence is stronger that we do see continued pullbacks rather than a rally from here. I'm not convinced that we see continued upside yet.
I think we would have seen way more bullish movement at the end of this week if we were actually going to be rallying up.
Yeah,
like we should be pressing on the highs and closing on the highs of the day, and we're not. I mean, it was one of the weakest dead bounces I've ever seen.
Yeah.
We'll see.
Okay.
All right. That's fun. Anything else I wanted to bring up, or any signs that you're seeing for You're saying that if the market does go down, though, what's your invalidation criteria? Like, do you have a time and date or a pricing on the S&P?
I mean, generally, when it comes to the S&P 500, I'm looking for where we close above or below the 200-day moving average. So I would want to see us invalidate if we push right back above 575, close above 575 for at least a couple of days. That would start to give me some confidence that the bearish thesis is starting to be invalidated.
Understood. Okay, perfect. So you have a price 575. I have a date April 2nd. And then if neither of the doomsday scenario happens then, you don't have to wait for the next after hours. Maybe start buying calls.
I could definitely see us closing above 575 by the end of April, though. So my date would be a little bit further than yours.
I see. Let's take a moment to shout out TradersPost, the automated trading platform designed to take the friction out of executing your strategies. Whether you're trading stocks, futures, or crypto, TradersPost connects seamlessly to your broker or exchange, giving you the flexibility to automate your trades without missing a beat. If you're tired of being the bottleneck in your own success, it's time to let automation do the heavy lifting. Head over to traderspost.io and see how easy it is to streamline your trading. TradersPost, because your strategy deserves to run at full speed.